All right, welcome back, candidates. Welcome to FinQuiz. Today, we're going to talk about ethics. Now, I know what some of you may be thinking. Ethics? Okay, so this is the part where we talk about being honest and not doing bad things. And yes, sure, that is part of it. But for the CFA exam, ethics is much more practical than that. So, ethics is about what happens when real money, real clients, real bonuses, real pressure, and real careers are involved. That is when judgment gets tested. So, let's begin with ethics and trust in the investment profession. Now, before we get into the details, I want you to understand something very important. Ethics is not just a small topic sitting at the end of the CFA curriculum. And it is not just a soft topic. It is not something you read casually and then move on. Ethics is one of those areas where CFA Institute is basically saying, look, technical knowledge is important, but technical knowledge without trust is dangerous. You can be great at financial modeling. You can build a beautiful DCF model. You can calculate duration, convexity, FCFE, residual income, option values, all of that. But if people cannot trust your judgment, your recommendations, your disclosures, and your behavior, then your technical skill does not create value. In fact, it can create damage. And that is the whole spirit of this first learning module, as you can see on the FinQuiz Battle Ready summary that you're seeing on screen. The first point is very simple but very powerful. Ethics and trust are essential foundations of the investment industry. Investment professionals are expected to act with integrity and high ethical standards because their work directly affects clients, firms, and financial markets. Now, let's slow that down. In many businesses, trust matters. Of course it does. If you buy a phone, you trust that the phone works. If you hire a doctor, you trust the doctor's diagnosis. If you hire a lawyer, you trust the lawyer's advice. But in investment management, trust is even more sensitive because clients are giving you something extremely personal. Their money, their future, their retirement, their children's education fund, maybe their life savings. Think about a retired couple. They do not understand every detail of equities, bonds, derivatives, alternative investments, fees, taxes, risk-adjusted returns, or portfolio construction. So when they sit across the table from an investment advisor, they are not just buying a product. They are trusting a professional. They are saying, I may not understand all of this, but I believe you understand it, and I believe you will not take advantage of my lack of knowledge. That is why ethics is central to this profession. Imagine an analyst at a big firm writing a research report on a company like Apple, Tesla, or NVIDIA. Now, the analyst knows the risks are serious, but the firm also wants investment banking business from that company. So the report becomes a little too positive, a little too soft, a little too friendly. Nothing dramatic at first. No one is running through the office yelling, ethics violation. It just looks like a polished report. But clients read it. Clients rely on it. Some clients invest based on it. And later, when things go wrong, they realize the risks were not presented properly. What happens then? Clients lose money. The firm's reputation gets hit. Regulators may start asking questions. Other honest employees may suffer. And sometimes people who did nothing wrong also lose their jobs because trust in the firm collapses. That is why CFA Institute wants you to understand that unethical behavior does not just harm one person. It can harm clients, colleagues, firms, and financial markets. So, folks, this is something I really want you to remember. Most unethical behavior does not begin with someone saying, today I'm going to destroy my career. Usually it starts with small compromises. Someone says, just this once, or everyone does it, or the client will not notice. And then it becomes something like, it is not illegal, or my boss wants it, or the bonus is huge, or maybe like the firm really needs this deal. And slowly, without even realizing it, judgment starts getting weaker. That is the danger. For the CFA exam, this is very important. Ethics questions often test those gray areas. The answer is usually not about choosing between an angel and a criminal. It is about recognizing pressure, conflict, weak disclosure, unfair treatment, or poor judgment before it becomes a serious violation. So when you see an ethics question, ask yourself, who is being affected here? Is the client getting the full truth? Is the professional being objective? Is anyone hiding risk, softening bad news, or putting personal benefit ahead of duty? That is the exam mindset. Now, another major point on the screen is that trust in financial markets relies on transparency, objectivity, and ethical conduct. In simple words, markets work better when people believe the game is fair. If investors think research reports are biased, performance numbers are manipulated, or insiders always win, then ordinary investors will step back. They may demand higher returns, avoid the market, or stop trusting professionals altogether. And once trust is gone, it is very hard to rebuild. That is why ethics is not anti-business. Actually, ethics is good business. A trusted advisor keeps clients longer. A trusted firm attracts better clients. A trusted market attracts more capital. So yes, ethics is morally right, but it is also commercially smart. Now, the last point on the summary is one of the most important ideas in this module. Ethics goes beyond compliance with rules. This is where candidates need to be careful. The CFA exam does not want you to think, if it is legal, it must be okay. That is too weak. Sometimes the law is unclear. Sometimes the law is slow. Sometimes the law does not cover a new product or a new situation. And sometimes something may be legal, but still not ethical. So the better professional question is not only, can I do this? The better question is, should I do this? That difference matters. Can I do this is a compliance question. Should I do this is an ethics question. And in the CFA exam, that difference can easily decide the correct answer. So to wrap up this introduction, here is the big takeaway. Investment management is built on trust. Clients trust professionals with their money, their goals, and their future. Unethical behavior can destroy that trust very quickly. And because rules cannot cover every possible situation, investment professionals must use judgment guided by ethical principles. That is the foundation of this entire learning module. Now, let's move to the formal meaning of ethics, where we talk about stakeholders, moral principles, codes of ethics, standards of conduct, and why ethical judgment is tested so often in real business life and on the CFA exam. Now, before we move forward, let me say something very practical from a candidate's perspective. Ethics is not difficult because the words are hard. Ethics is difficult because the exam tests judgment in messy situations. The curriculum gives you long explanations, but on exam day, you need sharp recall. What is the principle? Who is affected? What is the professional expected to do? That is exactly why we created the FinQuiz Battle Ready Summary. It compresses the reading into a clean, exam-focused structure so you can see the logic of the topic without drowning in pages and pages of text. Think of it as your revision map. When you are close to the exam, you do not want to search through the curriculum trying to remember where the key idea was. You want the concept in front of you, clearly organized, with the exam angle already highlighted. So if you want to revise smarter, not just longer, check the link in the description and get the FinQuiz Battle Ready Summary. It is built for candidates who want clarity, speed, and confidence when the exam is getting close. All right, now let's move to the next section. And don't worry, this is not going to be a boring, be a good person speech. In the CFA exam, ethics is much more practical than that. Ethics is what happens when money, pressure, clients, bosses, bonuses, and reputation all show up in the same room. So, as you can see on the screen, ethics is a system of moral principles that guides behavior and decision making. In plain English, ethics helps you answer this question: what should I do when my decision affects other people? Not just what makes me money, not just what keeps my boss happy, and definitely not just, can I technically get away with this? Ethics asks the better question: is this the right professional thing to do? Now, think about a real business situation. Suppose you are an investment advisor at a firm like JP Morgan. A retired client comes in and says, I need steady income. I cannot take big losses. You have two products. Product A is boring, lower fee, and suitable. Product B pays a higher commission, sounds more exciting, but has more risk than the client really understands. Now, your self-interest says, product B looks nice, but ethics says, hold on, is this really right for the client? That is ethics in action. No courtroom, no dramatic music, just a normal business decision where your personal benefit conflicts with the client's interest. And this is exactly the kind of judgment CFA Institute loves to test. So, folks, remember, the exam usually does not give you a cartoon villain saying, today I will violate the code and standards. It gives you a normal professional under pressure, a boss wants results, a client does not understand the risk, a bonus is on the table, and suddenly all three answer choices look reasonable. That is where your ethical judgment matters. Now, the next point is stakeholders. Stakeholders are the people or groups affected by a decision. Clients, employers, colleagues, regulators, investors, and society at large. This is a big exam idea. When you read an ethics question, do not just stare at the main character. Zoom out. Ask yourself, who is affected here? The client may be affected because they rely on the recommendation. The employer may be affected because the firm's reputation is at risk. Colleagues may be affected because one person's misconduct can embarrass the whole team. Regulators may be affected because market integrity is involved. And society may be affected because financial markets depend on trust. So, when an ethics question feels confusing, identify the stakeholders first. That usually clears the fog. The wrong answer often protects only one person, like the advisor, the boss, or the firm. The correct answer usually protects the proper professional priority, especially the client and the integrity of the market. Now let's talk about ethical principles. Honesty, fairness, diligence, transparency, and respect for rights. These are not just fancy words for a company website. You know, the kind of words firms put next to a smiling team photo and a coffee machine. These principles actually matter in real decisions. Honesty means you tell the truth about risks, returns, fees, limitations, and conflicts. Like, if a fund has high volatility, you do not call it stable income with growth potential just because that sounds nicer in a pitch deck. That is not communication. That is perfume on a problem. Fairness means you do not favor one client unfairly over another. Let's say if your firm has a new buy recommendation, you do not call your favorite client first and let everyone else hear about it later. That may feel like relationship management, but in CFA language, it can become unfair dealing. Diligence means you do the work properly. You do not recommend a stock because someone on X posted a chart with rocket emojis. That may be fun, but it is not investment analysis. In the CFA world, you need reasonable care, research, and a proper basis. Transparency means important information must be clear, not hidden in tiny font, not buried on page 47, and not explained so fast that the client just nods and hopes for the best. Real transparency means the client can actually understand the decision, right? And respect for rights means you respect client ownership, confidentiality, fair treatment, and the rights of others affected by your actions. Here is a quick warning sign for exam questions. If someone is hiding, exaggerating, rushing, favoring, or pressuring, be alert. There is probably an ethical issue nearby. Now let's move to codes of ethics and standards of conduct. Candidates sometimes mix these two, so keep it simple. A code of ethics gives broad values and expected behavior. Standards of conduct give more detailed rules and minimum acceptable behavior. Think of the code as the philosophy and the standards as the operating manual. A code says, we put clients first. Sounds great, but standards answer the real question. Okay, what does that actually mean on Monday morning at 9:15 when a trade has to be allocated? How do we disclose fees? How do we handle conflicts? How do we present performance? How do we protect confidential information? That is where standards become useful. Folks, remember, broad values means code of ethics. Specific required behavior means standards of conduct. That is an easy mark. Do not give it away. Now, let's talk about consequences of violations. Unethical behavior can lead to loss of trust, reputational harm, weaker organizations, and even exclusion from the profession. And this is not just theory. We have seen this in real business history. Enron, Arthur Andersen, Wirecard, Wells Fargo account scandals, FTX. Different industries, different facts, but the same basic lesson. Once trust breaks, the damage spreads fast. Suppose a portfolio manager manipulates performance numbers. Maybe poor accounts are quietly excluded. Maybe only the best strategy is shown. Maybe fees and risks are softened. At first, the presentation looks amazing. Clients are impressed. Money comes in. The firm celebrates. But later, when the truth comes out, the cost is brutal. Clients leave. Regulators investigate. The firm's name gets damaged. Honest employees suffer. And the person responsible may lose the right to work in the profession. So unethical behavior is not just a bad choice. It is business risk, reputation risk, legal risk, client retention risk, and career risk, all wrapped into one very expensive package. And this is where ethics becomes very real. Most unethical behavior does not begin with someone saying, "Today I'm going to destroy my career." Nah. Usually it starts with small compromises. Someone says, "Just this once," or "Everyone does it," or "The client will not notice." Then it becomes, "It is not illegal. My boss wants it. The bonus is huge," or "The firm really needs this deal." And slowly, without even realizing it, judgment starts getting weaker. That is the danger. For the CFA exam, remember this. Ethical lapses often begin with rationalization. People tell themselves a story that makes the wrong action feel acceptable. Your job in the exam is to spot that story before it turns into a violation. Now, the final point on screen is extremely important. Ethics requires judgment because laws may not cover all situations. This is huge. Ethics is not just memorizing rules. Rules matter, of course, but rules cannot cover every possible situation. Markets change, products change, technology changes, social media changes, AI tools change, crypto products appear, cross-border clients create new complications. And sometimes the law is silent, outdated, vague, or different from one country to another. So what does a professional do? A professional uses judgment. Suppose a new AI-driven investment product becomes popular. The local regulation has not fully caught up yet. The product is legal to sell. Clients are excited. Your firm wants to promote it. But you know the model is complex. The risk is not easy to explain. The fees are high. And the client may not really understand what they are buying. So the question is not only, is it legal? The better question is it ethical? Have I explained the risks clearly? Is this suitable for the client? Am I separating facts from opinions? Am I being transparent about costs and conflicts? Am I acting in the client's best interest? That is professional judgment. And in CFA ethics, this distinction matters a lot. As I said earlier, can I do this? Is a compliance question. Should I do this? Is an ethics question. And many exam questions live exactly in that gap. So in the exam, do not just ask, was it legal? Ask, was it ethical, fair, transparent, professional, and in the client's best interest? That mindset is the key. All right, before we move on, folks, always remember, ethics is not hard because the language is difficult. It is hard because the exam gives you messy business situations where the boss, the bonus, the client, and the rules are all pulling in different directions. That is where the FinQuiz Battle Ready Summary helps. It cuts the long reading into clean exam-focused points so you can revise faster and see exactly what CFA Institute is likely to test. Think of it as your ethics GPS. Less wandering, more direction. Check the link in the description and get the Battle Ready Summary before exam pressure turns your revision into guesswork. All right, let's move to the next section, ethics and professionalism. Now, this is where the module becomes very important because CFA Institute is not just asking, are you an honest person? It is asking something bigger. Are you ready to behave like a professional? There is a difference. A person can have a job. A person can have a title. A person can even wear a very expensive suit and still not behave like a professional. Professionalism is not just about looking polished on LinkedIn. It is about having specialized knowledge, using that knowledge responsibly, serving clients, and following standards that protect trust. That is the real idea here. Now, as you can see on the screen, this section has three main parts: the role of a code of ethics, professions, and trust, and professionalism in investment management. Let's start with the role of a code of ethics. A code of ethics is basically a public statement of values and expectations. It tells clients, employers, regulators, and the market, this is what we stand for. This is how our members are expected to behave. Think of it like a professional promise. A law firm may say, we protect client confidentiality. A hospital may say, we put patient care first. An investment profession says, we protect clients, we act with integrity, and we support market trust. Now, of course, saying it is not enough. Every company website says beautiful things. I mean, nobody writes on their website, we are flexible with ethics when the bonus is attractive. Everybody says integrity, but a real code of ethics matters because it sets the tone. It gives professionals a guide when the rules are unclear, when the pressure is high, and when the easy answer is not necessarily the right answer. For the CFA exam, remember this: a code of ethics gives broad values and expected behavior. It does not guarantee everyone will behave perfectly, but it publicly communicates what the profession expects. That is a very testable idea. Now, why does this matter for trust? Because clients usually cannot judge your technical work fully. If you are a doctor, most patients cannot independently verify your diagnosis. If you are a lawyer, most clients cannot fully evaluate your legal strategy. And if you are an investment manager, most clients cannot fully check your valuation model, your factor assumptions, or your portfolio construction process. So they rely on trust. And that trust is supported by education, standards, codes, monitoring, and discipline. That is what makes a profession different from just an occupation or a trade. Now let's define profession. A profession is an occupational group with specialized education, expert knowledge, high entry standards, continuing education, and a framework of ethical practice. In simple English, a profession is not just people who do the same kind of work. It is a group that says, we have special knowledge, society depends on that knowledge, and therefore we accept higher responsibilities. That is why doctors, lawyers, accountants, architects, and engineers are usually treated as professions. They do not just sell services, they carry responsibilities. And investment management is trying to operate in that same professional space. Now, another important point, professions differ from trade guilds because they emphasize service to society and enforce ethical conduct. This is a great exam distinction. A trade group may exist mainly to protect the interests of its members. A profession is expected to serve clients and society. That is a big difference. A profession says, our members are important, but the public interest matters too. That is why professional bodies create codes, promote education, monitor conduct, and sometimes discipline members who cross the line. And yes, that discipline part matters. Because without enforcement, a code of ethics can become just wall art. Nice frame, nice font, zero impact. Now let's talk about how professions build trust. The first way is through clear codes and standards. Clients feel more confident when they know professionals are not just making things up as they go along. There is a structure, there are expectations, there are rules of the road. Second, professions focus on client interest and fiduciary duty. Now, fiduciary duty is a key phrase. It means a duty to act with a high standard of care when acting for someone else's benefit. In normal language, if someone trusts you with their money, you do not treat that trust casually. You act with care, you act with skill, you act with diligence, and you put the client's interest where it belongs, at the front. Not behind your commission, not behind your boss's sales target, not behind your firm's quarterly revenue goal. The client comes first. Now, that does not mean the firm cannot make money. Of course, firms need revenue. This is finance, not a charity bake sale, right? But the professional standard says you do not make money by misleading the client, hiding conflicts, or recommending something unsuitable. That is the difference. Now, professions build trust through education and continuing professional development. This is also very practical. Finance changes constantly. New products, new regulations, new risks, new technology, AI, crypto, private markets, structured products, ESG, debates. The world keeps moving. So if someone says, I passed an exam 10 years ago, I am done learning, that is not professionalism. That is professional laziness wearing a tie. A real professional keeps learning. And professions monitor and sanction unethical conduct. This matters because trust requires accountability. If a member violates standards and nothing happens, the public loses confidence. But if the profession investigates, disciplines, suspends, or removes violators, it sends a message. Standards are real. And now the last bullet point, it says professions encourage collegiality and volunteer participation. This may sound softer, but it matters. A profession is not just a marketplace full of competitors. Professionals should respect one another, improve the field, mentor newer members, and contribute to stronger standards. In the CFA world, that could mean volunteering, mentoring candidates, contributing to local societies, participating in professional education, or helping improve ethical awareness. Now, let's move to investment management specifically. Investment management is newer than law or medicine. Why? Law and medicine have been recognized as professions for a very long time. Investment management, compared with those fields, is much younger. And because it is younger, public understanding is still developing. Many people still see finance as people in suits trying to make money. And honestly, after some scandals, you can understand why the public gets suspicious. So investment management has to work extra hard to build trust. And another point, lack of mandatory certification can lead to inconsistent ethical standards. This is very real. In some areas of finance, not everyone is required to have the same training, the same certification, or the same ethical commitment. One person may be highly trained and bound by a professional code. Another person may be selling investment products with far less background. From the client's perspective, that can be confusing. The client may not know who is truly qualified, who is just confident, and who is confidently wrong, which, by the way, is the most dangerous category. That is why recognized knowledge bases, certifications, and professional codes matter. They help signal competence and commitment. They tell the market, this person has studied a body of knowledge, passed rigorous exams, and agreed to follow professional standards. Now, this is where CFA Institute comes in. CFA Institute sets global standards, upholds the code of ethics, and requires ongoing professional development. The idea is to promote ethics, education, and professional excellence for the benefit of society. And that last phrase matters, for the benefit of society. CFA Institute is not saying, learn finance so you can sound smart at dinner. It is saying capital markets affect savings, retirement, businesses, innovation, jobs, and economic growth. So the people working in this industry must behave responsibly. That is the bigger picture. For exam purposes, expect questions around this idea. Investment professionals have a special responsibility because clients trust them with assets and because financial markets depend on confidence. So if an answer choice says, the main purpose of a profession is to maximize member income, be careful. That is too narrow. If it says a profession uses specialized knowledge in service to others, that is much closer to the CFA view. Now, let's bring this into a real business example. Imagine a wealth advisor at UBS, Merrill Lynch, or Morgan Stanley. A client has just sold a family business and now has a large portfolio to invest. The client is smart, but not financially trained. The advisor knows the client is relying heavily on professional judgment. Now, the advisor could recommend a product that earns a higher fee for the firm. It is legal, it is available, it may even be somewhat suitable, but there is another lower cost solution that better fits the client's needs. This is where professionalism shows up. A salesperson thinks, what can I sell? A professional thinks, what should this client own? That is the difference, and the CFA exam loves that distinction. Professionalism is not just technical skill, it is care, judgment, transparency, and ethical responsibility. A serious profession adapts to transparency, accountability, and technology. For example, 20 years ago, nobody was asking whether an analyst used ChatGPT to draft a report, or whether an influencer on TikTok was making suitable investment recommendations to millions of followers. All right, now, challenges to ethical conduct. And I'll be straight with you, this is the section where the CFA curriculum basically holds up a mirror and goes, so, you think you're one of the good guys? Let's talk about that. Here's the big idea before we get into it. Being ethical is hard. And it's not because most of us wake up in the morning plotting to do something shady. It's hard because there are these sneaky forces working against us quietly in the background. And if you don't know they're there, they will trip you right up. So the curriculum lays out 4 big challenges. Let's knock them out one at a time. First up, overconfidence bias. Okay, quick reality check about human beings. Walk into a room full of people and ask, who here is an above average driver? And what happens? Almost every single hand shoots up. Now, do the math on that for a second. That's mathematically impossible. We literally cannot all be above average. Well, guess what? The exact same thing happens with ethics. Study after study shows that most professionals genuinely believe they are more ethical than average. And that sounds harmless, right? Here's the trap. When you're that convinced you're the good guy, you stop watching yourself. You let your guard down. You think, oh, I would never cross that line. So you don't even notice when you're standing right on top of it. That's the danger. Overconfidence doesn't make you more ethical. It makes you blind to your own risk. So for the exam, lock this in. Being sure you're super ethical is actually a warning sign, not a gold star. Number 2, situational influences. And honestly, this might be the most important idea in the whole section, so lean in for this one. The curriculum's whole point here is that good, well-intentioned people do unethical things all the time when the situation pushes them hard enough. It's not always about a bad apple. Sometimes it's the barrel. So what kind of pressures are we talking about? Money, bonuses, promotions, prestige, loyalty to your teammates, and the culture around you, that unspoken, hey, this is just how we do things here. Let me give you a real one. Wells Fargo. A few years back, thousands of everyday employees opened millions of fake accounts that customers never even asked for. Were they all villains? No. They were regular people getting absolutely crushed by insane sales quotas, where if you didn't hit your number, you were gone. So they cut corners. The situation squeezed them and they cracked. That's the lesson. When the pressure is on, when that bonus is dangling right in front of your face, that is exactly when your ethics get tested. Good intentions do not make you bulletproof. Number 3, short-term focus. And this one goes hand in hand with situational influences. Here's the deal. Our brains are wired to want the reward now. The bonus this quarter feels real and shiny and close. The consequences, those feel far away and fuzzy. So the immediate payoff is screaming at us, while the long-term damage is barely whispering. Now, think about a mortgage broker back in 2008, getting paid on volume right now, this month, for every single loan they shoved through the door. The fact that a whole bunch of those loans were going to blow up years down the road. Not their problem today, so they kept the machine running. And we all know how that movie ended. This is the classic kick the can down the road mistake. When the small reward right in front of you feels bigger than the huge consequence way out in the future, people make genuinely terrible decisions. So remember for the exam, short-term focus makes the tiny reward look enormous and the massive consequence look tiny. And that is a recipe for disaster, folks. And finally, number 4, compliance cultures. This one's a little more nuanced, so stick with me. Now, compliance programs are a good thing. Rules, policies, procedures, the compliance department, all of that is genuinely useful. Nobody is telling you to throw it out. But here's the catch. When people just follow the rules mechanically, you end up with what we call a check-the-box mentality. You know the type. Did I technically follow the policy? Yep, check the box. Great, I'm covered. And they never once stop to ask the question that actually matters, which is, wait, is this even the right thing to do? Here's a wild one for you. Enron, right before it collapsed in one of the biggest frauds in history, had a thick 60-some page code of ethics sitting on the shelf. Rules for days. And it didn't matter one bit, because the culture underneath was rotten and nobody was actually thinking. They were just checking boxes. That's the whole point. Compliance is doing the bare minimum the rule book demands. Real ethics is actually thinking it through. And a company full of box checkers can totally miss the forest for the trees, because you can follow every rule on paper and still do something that absolutely stinks. So what's the fix? 2 things, and these are the exact takeaways the curriculum wants you walking away with. Number 1, recognize those situational influences we just talked about. Know that the pressures are real and they are quietly working on you right now. And number 2, always consider the long-term consequences before you act. Zoom out. Ask yourself, how does this look in 5 years? That combo, awareness plus long-term thinking, is what actually keeps you from stepping on a landmine. And fun fact, this is exactly why, just a couple sections from now, the curriculum hands you a full decision-making framework that forces you to pause and check for these very things. So let's tie a bow on section 4, the 4 challenges: overconfidence that blinds you, situational pressures that squeeze you, short-term focus that fools you, and compliance cultures that can lull you into just checking boxes. And the thread running through every single one of them? Real ethics is never automatic, and it is never about just being a good person on paper. It's about staying humble, staying aware of the pressures around you, and always, always keeping one eye on the long game. Nail this section, and you're not just battle ready for the exam. You're building the kind of judgment that keeps your whole career clean for the next 30 years. All right, let's keep it rolling. Section 5, ethical versus legal standards. And this one flows perfectly out of what we just covered, because in section 4 we talked about why being ethical is so darn hard. And right about now, there's a little voice in your head going, well, okay, can I just, follow the law and call it a day? And I love that question, but the answer is, no, not even close. And this section tells you exactly why. So let's dig in. First box, overlap but not identical. Here's the mental picture I want you to have. Picture 2 circles, right? One circle is legal, the other circle is ethical. And yeah, they overlap a lot. I mean, most of what we do every day is both legal and ethical. Paying your taxes, telling your client the truth, the normal stuff, cool. But here's where it gets spicy. Those 2 circles do not line up perfectly. So you've got this zone where something is totally legal, but super unethical. Perfect example, remember the whole pharma bro thing? Martin Shkreli. He bought the rights to a life-saving drug and jacked the price up from about $13 a pill to $750 a pill overnight. Was that illegal? Nope, not one bit. Was it wildly unethical? Oh, absolutely. People were furious, and, rightfully so. So that's your legal but unethical corner. The law said, sure, go ahead. But everybody with a conscience said, come on, man. And then flip it around. There's a zone where something is ethical but technically illegal. Think about whistleblowing. Somebody breaks a confidentiality agreement to expose a massive fraud that's hurting thousands of people. Technically, they broke a rule, but ethically, they're the hero of the story. Same idea with civil disobedience throughout history. So legal and ethical are like 2 different circles that just happen to overlap. They are not the same thing. Burn that into your brain. Second, limitations of law. Okay, so why don't the law and ethics just match up? Great question. And the curriculum gives us the reasons. Number 1, laws are reactive, meaning the law usually shows up after the bad thing already happened. It's always playing catch up. Perfect modern example, crypto. When crypto first blew up, there were basically no rules. The technology just sprinted way out ahead of the regulators, and the law spent years trying to catch up. Number 2, laws are slow to develop, sometimes vague, and here's a big one, inconsistent across countries. So something that's totally illegal here in the States, like certain kinds of insider trading, might be, a gray area or even perfectly fine somewhere else. Same exact action, different rule book. And the biggest takeaway of this whole box, legal standards are just the minimum. They're the floor, not the ceiling. Following the law does not guarantee you're being fair, and it sure doesn't guarantee you've got integrity. Third one, ethical standards go beyond law. And this ties it all together. So if the law is just the floor, what do real professionals do? They go higher. Ethics requires actual professional judgment, and it requires you to think about all your stakeholders, not just yourself. So a real professional doesn't just ask, is this legal? And stop there. They ask the bigger questions. How does this affect my client? What about my firm's reputation? What about the integrity of the whole market? Because look, you can do something that's 100% legal and still completely torch your reputation and blow up trust in the market. And there's an old saying that sums this whole section up perfectly. Just because you can doesn't mean you should. Okay, real quick, let me give you an exam tip because this concept shows up on the test all the time. Here's the classic trap. The question will tell you something is permitted under local law. And your gut is going to go, oh, legal, must be fine. Next question. No, that right there, that's the bait. Remember, legal is the floor, not the ceiling. And here's a little preview of something you'll see later in the standards. When the law and the CFA Code of Ethics clash, you follow whichever one is stricter. So legal but sketchy? Yeah, that can still be a violation. Don't fall for it. So let's tie a bow on Section 5. Legal and ethical overlap, but they are not the same circle. The law is reactive, slow, vague, and different everywhere, so it's just the bare minimum. And real ethics means going above and beyond that law, using your judgment and thinking about every single stakeholder, not just, whether you'll get in trouble. Nail this one and you'll dodge one of the sneakiest traps on the entire ethics section. And hey, real quick, if these battle-ready summaries are clicking for you, the complete set covering every single reading for level 1 is available over at FinQuiz.com. Go grab it, give yourself that edge on exam day, and, let's get you across that finish line. All right, on to the next one. Ethical decision-making frameworks. And, okay, this is the one I've been hyping up, so let's deliver. Because remember, in Section 4, we said being ethical is hard. All those biases and pressures messing with you. And in Section 5, we said the law is just the bare minimum. It won't save you. So you're probably sitting there going, okay, I get it. It's hard. But what do I actually do about it? And this right here is the answer. A framework is basically your ethical GPS. When you hit a messy, complicated situation and you don't know which way to turn, this thing walks you through it step by step so you don't just, panic and wing it. Let's break it down. So let's start with the purpose, the why does this even exist part. Look, a framework is here to help you analyze the genuinely complicated stuff. The gray areas. It forces you to balance everybody's interests, your client, your firm, the market, all of them, not just whatever's easiest for you. And a huge one, it reduces unintended consequences. You know that feeling when you make a snap decision and then a week later you're going, oh, I did not think that through? Yeah, the framework stops that. Over time, it fosters a whole culture of integrity. And here's a line the exam loves, so highlight it. Senior leadership is crucial. The tone gets set at the top. If the big bosses cut corners, everybody down the line figures, well, I guess that's how we do it here. Okay, now the main event. The framework steps. This is the part you absolutely have to know cold, so lock in. And good news, there are 4 steps, and they actually flow in a really logical order. Step 1, identify. Figure out the facts, who the stakeholders are, what your duties are, the ethical principles in play, and any conflicts of interest. Basically, what am I even looking at here? Step 2, consider. And oh man, this step should sound really familiar because you're literally considering those situational influences and biases we talked about back in Section 4. Plus, you go get additional guidance, maybe ask your compliance department, maybe check the firm's policy, and you brainstorm your possible alternatives. Because there's almost always more than one road you can take. Step 3, decide and act. You pick the best ethical option, and then here's the key word, you act on it. You actually do it. And step 4, the one everybody forgets, reflect. After the dust settles, you look back and go, all right, did that turn out the way I expected? And what can I learn from it for next time? And a quick memory hack for you, identify, consider, decide, and act, reflect. ICDR. Think of it like, I can decide right. That'll help you on test day. Third point, framework in decision making. And this is a little how it actually works note. First, frameworks are iterative and flexible. And this is super important, so listen up. It is not a straight line where you go 1, 2, 3, 4, done, walk away. It's a loop. You might get to step 3 and realize, oh shoot, I missed a stakeholder back in step 1, and you got to go back. In fact, look, it literally says it right there. It requires revisiting earlier steps. And why do we bother with all this? Because it ensures consistency, transparency, and accountability. So you're not just making it up as you go, you've got an actual repeatable process you can point to and defend. Okay, exam tip time. And this is a classic trap, so pay attention. The most common wrong answer on framework questions, people skip a step or they jam them out of order. And the 2 steps people mess up the most, number 1, they forget to reflect. They think the job's done the second they act. Nope. Reflection is a real official step. And number 2, they blow right past consider. They jump straight from identifying the problem to acting without ever pausing to check for their own biases and situational pressures. So if a question shows somebody making a snap ethical call without stopping to consider influences or, look at their alternatives, that's your red flag. That person skipped a step. So let's wrap up. An ethical decision-making framework is your step-by-step GPS for the tough calls. 4 steps: identify, consider, decide, and act, and reflect. I can decide right. And remember, it's a flexible loop, not a one-way street, so don't be afraid to circle back. Master this framework, and you're not just checking a box for the exam, you're walking away with an actual tool you'll use in your real career every single time the right answer isn't obvious. And hey, if these battle-ready summaries are making this stuff finally click, the complete set for all of level 1 is linked right down in the description. Go grab it, give yourself that edge, and let's get you across that finish line. All right, keep it rolling. And here we are, section 7, the conclusion. We made it. And this is where we zoom all the way out and pull the whole module together. So let me walk you through these final takeaways, because this is the stuff you want ringing in your ears when you close the book. Takeaway number 1, and this is the heartbeat of everything we've done: ethical conduct is crucial for trust in investment management. That's the whole ball game right there. I mean, think about it. This entire industry runs on trust. People are handing you their life savings, their retirement, their kids' college fund. And the only reason they do that is because they trust you to do right by them. So ethics isn't some boring add-on. It is the foundation. Takeaway number 2, codes of ethics guide you, but judgment and ethical frameworks are necessary. Remember this from earlier? A code of ethics is great, but it can't cover every single situation you'll ever run into. So at the end of the day, you still have to think. You still got to use that framework, the one we just learned. I can decide right. Remember, the rule book points you in the right direction, but your judgment gets you across the line. Takeaway number 3, and this one should sound very familiar by now. Laws set the minimum standards, but ethical standards are higher and forward-looking, right? Section 5, the law is just the floor, not the ceiling. And I love that word there, forward-looking, because the law is always reactive. It's playing catch-up. But ethics? Ethics looks ahead. It asks, what's the right thing to do, even when there's no rule for it yet? Takeaway number 4, high ethical conduct benefits all stakeholders, and that's your clients, your firm, the markets, and society at large. So this isn't some, zero-sum thing where being ethical means you lose. Nope. When you do it right, everybody wins. Your clients win, your firm's reputation wins, the whole market gets stronger and more trustworthy. It's a rising tide that lifts all boats. And takeaway number 5, the one to leave you with, long-term success depends on integrity, transparency, and trust. And this ties back to that short-term focus trap from way back in section 4. The shortcuts, the cutting corners, the chasing the quick bonus, that stuff might feel like a win today, but it torches you tomorrow. Real, lasting success, that is always built on integrity every single time. So let me tie the bow on this whole module for you. Ethics is the foundation of trust. Codes guide you, but your judgment carries you. The law is the floor, ethics is the ceiling. Everybody wins when you do it right. And long-term integrity is what actually pays off. That is learning module 1 in a nutshell. Okay, and before I let you go, let me just say this to you, straight from the heart. If you understood even the big ideas in this module, you are in fantastic shape for the ethics section. Seriously. So many candidates overthink ethics. They, tie themselves in knots. But you've got the framework now. You've got the instincts, so trust it. When you hit a tough question on exam day, just slow down, think about the stakeholders. Remember that legal is the floor, not the ceiling, and, choose the higher road. That's it. That's the whole game. And hey, one last thing. If these battle-ready summaries have been carrying you through, do not stop here. The complete set, every reading, every topic for all of Level 1, it's linked right down in the description. Go grab it because you have worked way too hard to leave anything to chance now. Give yourself that edge. So that's a wrap on Ethics Learning Module 1. I am genuinely proud of you for putting in the work. Now go get some rest, come back strong for the next one, and let's go pass this exam. You've got this. I'll see you in the next session.